Today's lecture will focus on Chapter 18, Retirement Planning, Starting Early. So there are many misconceptions about retirement. My expenses will decrease when I retire. Well, that will be true on some things, but some things will also get more expensive, such as healthcare. My retirement will only last 15 years. Well, if you properly plan it, it'll last a lot longer than that. And that Social Security and my company pension will pay for my basic living expenses. Don't count on that. In addition, my pension benefits will increase to keep pace with inflation. They may go up a little bit, but may not be able to keep up with inflation to the extent you have any. And I think the biggest one is that saving just a little bit won't help. Yes, it will help, especially if you start early. We'll talk about that here momentarily. Listen, as you know, retirement is a trade-off. What you do today will have a direct effect on your retirement many years from today. And so only by saving now and curtailing your spending habits will ensure a more comfortable retirement later. And as we've talked about even back in Chapter 1, here, that, look, if you wait, every 10 years you wait, has a direct impact. So that in essence, people are spending 16 to 30 years into their retirement, and Social Security often will be insufficient to cover your cost of living, not to mention the horrible effects that inflation will have. We also talked about compounding back in Chapter 1, and really all I need you to look at is the bottom bullet point, that for every 10 years you delay before starting to save for retirement, you'll need to save 3 times as much to catch up. Okay. So retirement planning, you got to know where your current assets and liabilities are. That's why you did your first budget spreadsheets. The first step is to review your assets, again, as well as your current liabilities when you're starting financial analysis with regards to retirement. So probably for many people, maybe for you not yet, but for many people, if they own, their house is their biggest single asset. So you can sell your home to buy a less expensive one, or if you have a lot of equity, you could do a reverse mortgage. So a reverse mortgage is a mortgage where the lender uses the borrower's house as collateral to buy an annuity for the borrower from the life insurance company. So in essence, you're using your equity in your house to get payments. So it's nice, but what happens is, in essence, you're screwing your inheritance for your kids or whoever you're planning to give the house to, because either when you die or when you sell it, you got to pay back the annuity. So when you have a reverse mortgage, you're still responsible for such things as the property taxes, the insurance, maintenance, utilities, and other expenses. I would highly recommend not getting a reverse mortgage. People who get reverse mortgages are ones who didn't save enough and are forced to do it. Other assets that you might have is life insurance. So the cash value of life insurance can be converted into an annuity. We'll talk more about annuities here in a second. And you're obviously going to have other investments, stocks, hopefully bonds. You may have some, collectibles, etc. Now, I hate to say this, but 50% of people do get divorced in the United States, so your assets are directly affected by divorce. If you have a pension, that's considered marital property to be divided. So, as you said, some expenses will go up. However, some expenses will go down or even stop, such as you're not going to be contributing to a retirement fund. You're going to be drawing on that as funds, so you'll have more money for that. In addition, Other things that may go down is such expenses related to work, such as gas or lunches. Your work clothing expenses usually be less expensive because you're not buying as many clothes. Your housing expenses may stop if your house is paid off, but certain things may still go up, such as your insurance and your property taxes. And usually your taxes, well, federal and state usually are lower for most people. However, certain expenses may go up, as we noted: insurance, auto insurance, life insurance, health insurance. And just in general, medical expenses go up with age as you have more medical expenses as you get older. Leisure activities may go up because you have more time to do leisure activities that you didn't while you were working. Your gift and contributions may increase, especially if you have a large family with many kids and grandkids. So the most thing is that you need to adjust your expenses for inflation, because we know that over time the price of goods and services do go up. So think about the house you're living in now, but more importantly, think about where you're going to may or may not live in the future. Such things as climate, people, transportation, and taxes. And I believe there are 7 states currently that have no state income tax. That's a big thing to consider. Think about your family, your proximity to children or good friends. Now, for the people who don't want to move to a new place, over 90% want to stay in their own home because that's what they're comfortable with. They know their neighbors, they know the community. So if you are going to stay in your home, you may want to redesign it, and that's a universal design home. So you want to make sure it's more wheelchair accommodable, etc. So if you're going to move to a place that has closer to family or better weather or better taxes, you should probably consider at least visiting the area for a while. You may even want to rent for a while instead of buying, just so you make sure you like the neighborhood and you like the area, because once you buy, you could be trapped there for a while. Remember, houses are not liquid investments. So where are going to be the sources for your retirement income? Well, Social Security will be one, and that's fine. You're eligible to start taking Social Security as early as 62 for reduced benefits, but full retirement benefits don't start until age 67 for basically all of us in this classroom. You don't have to take Social Security at 67. You can wait all the way till you're up to 70. The longer you wait, the more you get. If you take it before age 67, you'll get reduced benefits. Social Security doesn't cover all workers. There are some workers who don't get Social Security, such as if you work for possibly the government that has a pension plan. Social Security should be part of your retirement income, but not the sole source. So you need to apply prior to when you want to take your Social Security. Social Security is taxable. A lot of people think it's not. It definitely is. There are cost of living adjustments or COLA adjustments each year for Social Security. But I'd caution you on relying too much on Social Security. That Social Security is not sustainable over the long term at current rates, and to the extent we're borrowing at record numbers right now to keep the economy going afloat, that's even going to be more profound. Back in 2015, the Social Security trustees estimated that the Social Security Trust Fund will be exhausted by 2033. So, and people are living longer, and they're collecting benefits for a longer period of time. As you can see from the bottom of the slide, that the baby boomers will be retiring soon, and thus the ratio of workers to retiree is going down dramatically. So you can see that here in 16 years, in 2036, it's estimated that there will only be 2.1 workers per each retiree. And so there's more people drawing on Social Security and less people funding it. Now, these are public pension plans, so these are people who work for the government, whether federal or state. They oftentimes are entitled to a pension, which is very nice. However, most people do not work for a public employer, they work for a private employer. So we'll look at some plans here. First one is what's for a private employer is a defined contribution plan. And that's nice if your employer still provides this type of plan. However, most of them do not. So you take a look at some of these, such as a money purchase pension plan or a stock bonus plan, profit sharing plan. Notice that you see your employer's contribution. Well, many employers have stopped doing this. Instead, with defined contribution plans, many employers have gone to where the employee funds it instead of the employer. This can be done through a 401k in the private industry. In the public industry, it can be through a 403b for a nonprofit or 457 plan for the government. Under these, the employer, to the extent the employee makes contributions that are pre-tax, you don't have to pay taxes here, and sometimes the employer makes a matching contribution. So please understand that the employee makes the contributions, and sometimes, rarely, the employer will match a part of it. Since it's funded with tax-free money, you know that the earnings grow without current federal taxation, and when you withdraw it is when you pay the tax at the ordinary income tax rate. Very few private employers have what's called a defined benefit plan. This is where the employer, the company, will pay you a certain amount per month when you retire. It's usually based on your final year's retirement salary, number of years of service, and some percentage. But it's a guaranteed payment. Most plans, at least with 401ks, can be portable. We'll talk about that here in a second. Also, you need to understand what vesting is. Once your plan vests, that means it's your legal right to at least a portion of the benefits you have accrued under an employer pension plan, even if you leave the company before you retire. So if you're in the private industry here and you change jobs, let's say your first job, you put money into a 401k plan and you leave your job, you have 4 options. One is you can leave the funds in an employer's plan, and that's fine, but let's say you change jobs 7, 8 times. You don't want to have 7 or 8 different 401ks. What you can do is roll the funds over into your new employer's plan. That's fine. That way you only have one. Every time you switch a job, you roll over your 401k into a new plan. That's fine. That's good. What I would do, though, is roll over the funds into an IRA or an individual retirement account, because now you have the choice on how you want it invested. As you know from our lecture on mutual funds, when you put money into a 401k, it's often into a mutual fund, and you don't have the control. The IRA gives you the control. The one thing I would not do is option 4, to cash out, pay the taxes. Now you've lost your retirement and you were taxed on it. So let's move away from the employee-employer relationship and look into retirement accounts funded by you individually. An individual retirement account. And there are many types of IRAs that we'll talk about in the next several slides. The first one is called a regular traditional IRA. So it says here, gives you the funds, the amounts in 2018 you can contribute, but now we're in 2020. So as of 2020, you can contribute $6,000 and an extra $1,000 if you are 50 or older. Also, it shows you that our RMD age at 70 and a half as of 2018, that's the required minimum distribution. That just got raised this year, so now it's 72. So you don't have to start drawing out of it until you're 72. Now, a Roth IRA is another type of IRA. The difference, obviously, between a Roth IRA and the traditional IRA on the previous slide is that the Roth IRA is funded with after-tax contributions, which means you've already paid tax on the amounts that you're contributing. But the beautiful amount is just like the traditional IRA. With the Roth IRA, it grows tax-free, but in the Roth IRA, you do not have to pay any federal or state income tax when the money is withdrawn. And again, since you don't have to pay any taxes, there's no RMD. There are some other IRAs I want you to at least be familiar with. A spousal IRA lets you contribute amounts on behalf of your non-working spouse. You have to file a joint tax return. Rollover IRAs accept rollovers from another retirement plan, such as a 401k plan that we just talked about. Coverdell Education IRAs allow you to give $2,000 to each of your child for purposes here of their education. It's after-tax money, just like a Roth IRA. Finally, SEP IRAs are ones founded by your employers, or if you're self-employed. A more advanced type of retirement plan for self-employed people are known as a KEO plan. But the most important thing to understand, unless it's like a Roth IRA, when you take out your money, if it's a regular IRA, it's taxed at ordinary income tax. That's why if you live in the state, a tax-free state, that gives you a huge advantage. Don't take out your money early. You gotta wait till at least you're 59 and a half, or else there's gonna be a penalty. So let's talk a little bit about annuities now, and I would highly not get an annuity. It would be the last thing I would do unless I completely funded everything out, and even then I would never get an annuity. So an annuity provides the person who purchases the annuity a guaranteed income for life. But again, don't fund an annuity unless all your other retirement plan options have been fully funded. Why would you get an annuity? In essence, you are giving money to an insurance company to make your payments. And when you die, for the most part, your heirs get nothing. They are hard to get out of. The contract is ridiculous. So there are different types of annuities. An immediate annuity begins payouts right away, used by generally older people. Deferred annuities is where you put in money now and you don't get payments yet. You wait, used by younger people. A straight line annuity provides more income than other types, but the payments stop when you die. And those are, most annuities are straight line annuities. As you can see, there are other types of annuities on here as well. You can see how much I love annuities. So again, make sure that you can properly live on your retirement income. Make sure that you get all the retirement income of which you're entitled to. Develop a plan. We talked about that plan before. Take advantage of all the tax savings for retirees, and there are those. Finally, you may still need money during retirement, maybe working part-time. And if you don't have to work, maybe volunteering at least. Get out of the house to the extent you can. You can still invest some of your money that you get in during retirement as well. And take as long as possible to dip into your retirement nest egg, because you don't know how long you will live. The average male is living to 80, the average female is living to 87. This concludes our lecture on Chapter 18, Retirement Planning, Starting Early.